mass panic as half of U.S. banks on the brink of collapse. Withdraw your money now. The U.S. banking system is teetering on the brink of collapse. Official reports show that almost half of all banks in the country are on the verge of bankruptcy. This means your money might not be safe in these banks anymore. It's time to seriously consider finding other ways to protect your wealth. In this video, we'll uncover the terrifying truth about this banking crisis and why it could lead to a financial catastrophe even worse than the 2008 crash. The horror began with the bank failures of 2023. It started with the relatively small Silvergate Bank, which failed on March 8th. The very next day, the much larger Silicon Valley Bank, SVB, collapsed. SVB had over $120 billion in uninsured deposits. Deposits over $250,000 are not covered by FDIC insurance, so those depositors risked losing all their money above that amount. This could have wiped out hundreds of tech startups in Silicon Valley that had their money in SVB. Major companies like Cisco and at least one big cryptocurrency exchange also had billions on deposit there, facing enormous losses. On March 9th, the FDIC declared these excess deposits uninsured, offering depositors receivership certificates with uncertain value and no liquidity. However, by March 11th, the FDIC reversed its decision and insured all deposits. The Federal Reserve intervened, offering to exchange any U.S. Treasury securities from member banks for cash at par value, even if the bonds were worth less. That same night, regulators shut down Signature Bank, a New York-based bank with cryptocurrency connections. The crisis didn't stop there. On March 19th, the Swiss National Bank forced a merger between UBS and Credit Suisse, one of the world's largest banks, because Credit Suisse was on the brink of collapse. Finally, on May 1st, the government ordered the closure of First Republic Bank, which had over $225 billion in assets, and sold it to JP Morgan. This was the largest bailout ever. Despite these drastic measures, important questions remain. What can be done in the next crisis if all deposits are already guaranteed and every bond is financed at par value? What options are left, aside from nationalizing the banks? After 5 bank failures in 2 months and a $1 trillion government bailout, it seemed like the crisis was over. However, this sense of relief was misleading. Financial expert James Rickards warned that the crisis was far from over.
I've been signaling a recession for a long time. So a lot of economists, and I would include myself, have said, there was going to be a recession in 2023. According to the data, that didn't happen. Maybe we fell into one around November, December. We won't know for another 4 or 5 months. We'll see what happens.
It was merely in a lull. Many investors believe the banking crisis has ended, but this is a significant mistake. History shows that major financial crises develop in stages, with a quiet period between the initial and critical phases. Rickards explained that this pattern has occurred in several past crises. For example, in 1994, the spring bond market massacre seemed contained by summer, but erupted into the Mexican tequila crisis in December. Similarly, in 1997-98, the Asian financial crisis appeared to calm down in the winter of 1998, only to flare up into the Russian LTCM crisis the following August and September. During the global financial crisis, initial distress in August 2007 seemed contained, but it was followed by the failures of Bear Stearns, Fannie Mae, Freddie Mac, and Lehman Brothers from March to September 2008. The average duration of these financial crises is about 20 months, indicating that much can go wrong in the coming months. This crisis could reach a severe stage more quickly because modern technology allows bank runs to happen very fast. With a smartphone, you can transfer $1 billion from a failing bank while having dinner at home. There's no need to wait in line. Essentially, the second stage of the crisis could happen dramatically and sooner than expected. The slow-motion crisis can quickly become a real-time crisis. Additionally, regulators respond faster because they have experienced similar situations before. However, this raises the question of whether regulators have any options left since they have already guaranteed nearly everything. It's important to distinguish between individual bank failures and a systemic banking crisis. When individual banks fail, Depositors and creditors are usually protected, but stockholders can lose everything. In a systemic banking crisis, the problem spreads rapidly from bank to bank, requiring the entire system to be rescued through blanket deposit guarantees and unlimited quantitative easing. In the worst-case scenario, banks either need to be shut down, as FDR did in 1933, or nationalized, as some countries have done. Either a single bank failure or a systemic crisis could occur at any moment, with the actual trigger being somewhat mysterious and psychological since the fundamental problems have always been there. It appears that the quiet period is over, and we are now entering stage 2 of the banking meltdown. Indicates that the Federal Reserve's recent interest rate hikes have made the U.S. banking system very fragile. Many banks are at risk of failing if there is a run on these banks by uninsured depositors. This risk comes not only from a decrease in the value of bank assets, but also from uninsured depositors' strong impulse to withdraw their funds during a crisis, leading to bank failures. The FDIC recently published their quarterly report with alarming news, revealing a list of problem banks that are near insolvency. According to the report, many banks could fail as unrealized losses on securities reached $177 billion in the first quarter of 2024, up from $39 billion. Unrealized losses are the difference between the price banks paid for securities and their current market value. This significant increase occurred in just one quarter, not over a year or a decade. Additionally, 40 banks with over $1 billion in assets have already reported unrealized losses exceeding 50% of their equity capital. More than 200 smaller banks with fewer assets have issued similar reports. Economist Ambrose Evans Pritchard recently reported that almost half of America's 4,800 banks are depleting their capital buffers. Even though they may not have to mark all losses to market under U.S. accounting rules, this does not make them solvent. Someone will incur those losses. It's unsettling, said Professor Amit Saru, a banking expert at Stanford University. Thousands of banks are underwater. He continued, "Let's not pretend that this is just about Silicon Valley Bank and First Republic. Much of the U.S. banking system is potentially insolvent." A Hoover Institution report by Professor Saru and a group of banking experts estimates that more than 2,315 U.S. banks currently hold assets worth less than their liabilities. The market value of their loan portfolios is $2 trillion lower than the stated book value. These lenders include major institutions. One of the 10 most vulnerable banks is a globally systemic entity with assets over $1 trillion. 3 others are large banks. Saru emphasized that this isn't just a problem for banks under $250 billion that didn't have to pass stress tests. Commercial real estate and industrial properties are entering the early stages of a severe slump. "We are facing a nearly perfect storm," said Jeff Fine, a real estate expert at Goldman Sachs. "Rates have risen by 400 to 500 basis points within a year, and financing markets have nearly completely shut down. We estimate there's $4 to $5 trillion of debt in the commercial property sectors, of which about $1 trillion is maturing in the next 12 to 18 months, he stated. Now, packages of commercial property loans, CMBS, are typically on short maturities and must be refinanced every 2 to 3 years. Borrowing surged during the pandemic when the Fed flooded the system with liquidity, and that debt matures in late 2024. So far, U.S. commercial real estate prices have dropped by an average of 25%. Capital Economics expects a peak-to-trough decline of double that amount. This will further damage the loan portfolios of regional banks that account for 70% of all commercial property financing. This could create a doom loop, which accelerates a real estate downturn that then feeds back into the banking system, said Neil Shearing, the group's chief economist. Once again, mortgage-backed securities are at the heart of the problem. Remember the subprime mortgage crisis of 2008 when everything collapsed due to around $1 trillion in mortgage-backed securities causing the bubble to burst? We've just witnessed a significant increase in unrealized losses in just 3 months, a substantial issue. The most worrying aspect is that we don't know which banks are in trouble. It could be my bank, it could be yours. The list is confidential to prevent the likelihood of bank runs finishing off these institutions, so we simply don't know. What we do know is that the FDIC has the funds to replace only 1.17% of the qualified deposits in America. If your bank fails, you'll get your money back after some months of waiting, but what if your bank is further down the line? Good luck. We saw this happen with several banks last year when only 12 were on the brink. Now that number is much larger. Last year, we also saw that the FDIC made a plan for a bail-in using taxpayer money. This means that if a systemic banking crisis occurs, we will be the ones paying for it. The root cause of this crisis lies in the erratic behavior and perverse incentives created by the Fed and the U.S. Treasury over many years, culminating in the aggressive reversal from ultra-easy money to ultra-tight money now underway. They first created interest rate risk on a massive scale, and now they're detonating the delayed time bomb of their own creation. Chris Whalen from Institutional Risk Analyst cautioned against a false narrative that places all the blame on reckless banks. He said the Fed's successive open market interventions from 2019 through 2022 were the primary cause of the failure of First Republic and Silicon Valley Bank. Mr. Whalen noted that U.S. banks and bond investors, such as pension funds and insurance companies, are holding the bag on $5 trillion of implicit losses left by the final blow-off phase of the Fed's QE experiment. Since United States banks only have about $2 trillion in tangible equity capital, we have a problem. He predicts that the banking crisis will keep moving up the food chain from the original outliers to mainstream banks until the Fed backs off and slashes rates by 100 basis points. However, the Fed has no intention of backing off. In fact, it plans to raise rates further. It continues to shrink the U.S. money supply at a record pace, with $95 billion of quantitative tightening each month. The harsh reality is that the world's superpower central bank has made such a mess of affairs that it has to choose between two poisons. Either it capitulates on inflation, or it lets the banking crisis reach systemic proportions. It has chosen a banking crisis, noted Ambrose Evans Pritchard. So, what's the bottom line? Stage 2 of the crisis is already upon us, and the effects will be devastating to financial institutions, the stock market, the economy, and our personal finances. Are you ready for what's coming next? Don't forget to subscribe for more videos like this.